Hey everyone, welcome back to Corporate Decoder. Today we are diving into a filing that hints at some dividend payouts, but are things really as rosy as they seem? Let's find out if this company is truly rewarding its shareholders or just putting on a good show. This Form 8K filing from Seritage Growth Properties gives us a quick snapshot of a dividend declaration. It sounds simple enough, but we need to see if this dividend is sustainable and what it really means for the company's financial health. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where you can discuss all things corporate finance. This document is a standard SEC filing, a Form 8K, which companies use to announce major events to their investors. In this case, it's about a dividend announcement. This report is dated May 8, 2025, telling us that the event it describes happened on that day. This helps us keep track of when this information became public. This is filed by Seritage Growth Properties, a real estate company. Knowing who's making the announcement is crucial as it sets the context for understanding the news. We see here that Seritage has different classes of shares, including common and preferred shares. The preferred shares are the ones getting the dividend in this announcement. This section tells us the specific event being reported, the declaration of a cash dividend. Here's the heart of the matter. Seritage is declaring a cash dividend of $0.4375 per share for its 75R per shares are a special type of stock that usually pays a fixed dividend. In this case, the dividend rate is 7.9. Ich hein Davidoren roughly 44 cents per share. The preferred dividend will be paid on July 15, 2025 to those who own the shares by June 30, 2025. This is important for investors who want to receive the dividend. They need to own the shares before the record date of June 38. Now, what's the story here? On the surface, a dividend declaration sounds positive. It suggests the company has enough cash to reward its shareholders. However, we need to ask a few questions. Is this dividend sustainable? Is it a sign of genuine financial health? Or is it just a way to boost the stock price temporarily? To really understand what's going on, we'd need to dig into Seritage's financials from their latest quarterly or annual reports, which are called 10Q and 10K filings, respectively. We'd want to see their cash flow, profitability, and debt levels. Is the company consistently making enough money to cover these dividends? Or are they borrowing money or selling assets to keep the payouts going? If they're capped and nabbled, is the company consistently making enough money to cover these dividends? Or are they borrowing money or selling assets to keep the payouts going? If they're selling assets, it might give them cash now, but it can hurt their future ability to make money. It's like selling your equipment or shop in order to pay for some short-term debt. Also, we need to think about what else the company could be doing with that cash. Are there better ways to use the money, like reinvesting in the business, paying down debt, or making acquisitions that could boost long-term growth? Sometimes paying a dividend can be a sign that the company doesn't have better ideas for using its cash, and that is rarely a great look. Another important question is why preferred shares and not common shares. Preferred shareholders often have a higher priority when it comes to dividends. This means they get paid before common shareholders. This could indicate the company is trying to keep its promises to preferred shareholders who might have invested with the understanding they would receive regular dividends. Without digging into the financial statements, it's hard to say for sure. A dividend can be a good thing, showing a company is profitable and sharing its success with investors. But it can also be a warning sign if the company is struggling and using the dividend to mask deeper problems. Or in Let's Get to My Take, I see both strengths and weaknesses in this situation. On the one hand, paying a dividend can attract investors and boost confidence in the company. It shows that Seritage is trying to provide value to its shareholders. However, I'm concerned about the long-term sustainability of these dividends. Real estate can be unpredictable, and Seritage has faced challenges in the past. Without strong and consistent cash flow, these dividends could become a burden. It would be great if we had the data here, but we don't. A notable risk for Seritage is the overall health of the retail industry. Many of their properties are retail spaces, and if retailers continue to struggle, that could hurt Seritage's rental income and ability to pay dividends in the future. They need to adapt to the changing landscape, perhaps by diversifying their properties or attracting new types of tenants. They could also focus on e-commerce and try to compete with online businesses. In conclusion, while the dividend announcement is positive news, investors should proceed with caution. They need to look beyond the headline and dig into the company's financials to understand the true picture. A company that is struggling with its financials isn't an ideal situation, and you probably should invest in other options. Alright, that's our breakdown of Seritage's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.